Hello, everybody. Ed Yardeni here. It's August 25th. It's Monday, and the summer is almost over. It's sad but true. I don't recall a summer going by quite this quickly. I'm not quite sure why that is, but maybe it's because I'm writing these quick takes now, and I'm watching the calendar every single week and and kind of planning ahead here, and just the pace. The pace of time seems to be accelerating here. Anyways, here in Long Island, we've got a beautiful day today. Past few days have been great. It's been kind of a spotty summer. We've had some heat waves, some rain, and but the past few days have been spectacular, which is great because I got some of my uh, family members here visiting, and so we're having a good time. At the end of the summer. I hope the same as it can be said for what you folks are having a good time this summer with your family, friends, and that the weather's been relatively good. Well, stock market's been great, right? Uh, Nobody can really complain about that. The only question is where does it go from here? And it seems increasingly as though the question is, does it go up at a leisurely pace or does it go up in a melt-up fashion? And seeing more and more people kind of thinking maybe this is deja vu all over again, kind of like 1999, party like it's 1999. And that's seems to be the opinion of some people. My opinion is that it's all going to probably depend on the next few weeks, what the data shows and what that implies about what the Fed Chair Powell winds up doing, along with his committee, with the federal funds rate. On Friday, before you spoke, I thought that he could be either dovish, hawkish, or owlish. Uh, and owlish, of course, is somewhere between dovish and hawkish. It's kind of non-committal. It's kind of keeping your eyes wide open and looking all around you for possible danger signs, but not flying anywhere, not doing anything, just kind of sitting there waiting to decide what to do next. And maybe the thing you decide to do next is to do nothing, to continue to keep your eyes wide open and continue to uh, be aware of what's going on. Well, instead, Powell clearly came across as dovish, and partly that's because of what he didn't say. For the past several months, he's been saying that the Fed is in no rush to lower interest rates. That itself is a fairly dovish statement because it says they're not thinking about raising rates. They're not thinking about keeping rates on pause for a long time. It means that they want to lower rates, but they're in no rush to do so. And what they're waiting for is for inflation to get closer to their 2% target and for the economy to continue to demonstrate that it's resilient. Well, I guess because of the payroll employment report we had at the beginning of the month, which showed that there wasn't much employment growth in May and June, that the markets certainly concluded that this increased the odds that the Fed would ease and that Powell might be dovish at the Jackson Hole speech, which he was by not saying anything about holding off, waiting for lowering interest rates. And instead, well, he said he didn't say we're in no rush to lower interest rates. Instead of what he said, maybe it's getting time for an adjustment. And since we're all focusing on adjusting interest rates down, clearly the markets concluded that Powell is signaling that he is ready to consider lowering interest rates at the September 17th meeting. He did, after he said that, immediately say, of course, we're still data dependent. We'll always be data dependent. We'll never deviate from being data dependent. But the market clearly, correctly read what he didn't say, which is we're in no rush. So maybe they are in a rush now. Maybe they are going to move on September 17th. But again, I think we all know that there are a couple of important data points at the end of the month. We'll get the consumption expenditures deflator, and that will be for July. We already know what the CPI was for July. We know what the PPI was for July, and some of the components of the PPI will be in the PCED, and a lot of the components of the CPI will be in the PCED. And on balance, I think we can expect a number like 3.0%. In his speech, by the way, Powell said that based on current estimates, it looks as though the inflation rate will be 2.9% on a year-over-year basis in July. But as I said, I think it's going to be something more like 3%. Well, big deal. I mean, zero point 0.1, that's no big deal. But we've seen the market move in a pretty dramatic fashion before on pretty piddling, zero point 0.1 kind of surprises. So we'll see how that plays out. But then, of course, the employment report will come out in early September for August. And that could be interesting. Initial unemployment claims suggest that layoffs remain low. On the other hand, continuing claims suggest that as people become unemployed, it's tough finding a job so that they stay unemployed longer. The duration of unemployment goes up. And there are a lot of factors that could be behind that. There could be weakness in demand, which would justify a Fed rate cut. There could be an issue of skills mismatch, that there really are quite a few jobs out there, but the skills that are offered by those who are unemployed don't exactly match that. We know that the duration of unemployment is increasing, particularly among teenagers and kids graduating from college. And they don't really have much in the way of they don't have much in the way of experience. They don't have much in the way of skill sets, and perhaps the economy is becoming more sensitive to availability of skills, and that could be related to AI. It could be related to the technology, the digital revolution, the transformation of our economy using technology. Back in the late 1990s, the technology revolution was all about laptops, desktops, and we had basically two apps back then. We had Excel and Word. They were very powerful apps, made a lot of difference in increasing the productivity for typing things and for accounting for things. But that was kind of it. Now we've got hundreds of thousands of apps, lots being created, and as I recently have seen, you walk into most kind of fast food restaurants these days, and they all have these iPads where you just put in what your order is, take a number, sit down, and they'll bring you the food. In other words, there's productivity going on in the restaurant business. You go to a doctor these days, and you have to sit down and fill out a form. It's no longer paper. It's all on an iPad. They now, I understand, the hospital systems are incorporating their systems through something called Epic. So if you get an X-ray in one hospital, and you have to go to another hospital for one reason or another, they'll be able to look at your entire record through Epic, which is a big productivity booster, I think. So information technology is really making headway in an industry that's been historically pretty primitive when it comes to technology. So it may be that there's really are fewer jobs available for teenagers in the hospitality industry, for example. And college graduates, well, we all know how screwed up the whole college system has been. It's just ridiculously expensive. The student loans are ridiculous. And the offerings of all the courses that they teach there are too many of them, and mostly the offerings that are fine to take, when you're retired and you want to think about the meaning of life with a little bit of retrospect. But a lot of the courses really don't focus on teaching our kids skills that they can actually use. A lot of them are coming out with degrees in communications and business, and the question is, what the heck does that mean? What do they really know about working in a business? So there's a lot of things going on in the labor market. There's the freezing of immigration at the border anyways. There's deportation going on. We know that the supply of labor, the labor force, has been declining, and a good part of that is because of foreign-born labor supply, and that certainly could be having an impact on the ability to find workers in some areas. So it's a very, very mixed picture. But on balance, I think the labor market's still okay. It's looks like 4.2% is the unemployment rate. Initial unemployment claims remain very low, consistent with something just north of 4% on the unemployment rate. But Powell has decided that, I guess in reaction to the July payroll employment numbers, the weakness, and he focused on May and June. I focused on May, June, and then I see a 73,000 increase in July, and I said, well, maybe May and June we had some uncertainties out there that kept employers from employing people, and so we had a real slowdown in hiring. But then we had 73,000 in July, which is a nice recovery from 14,000, 19,000 in May and June. I guess that could be revised downward. We'll see what happens. But I'm looking for 100,000 for the payroll employment number in early September for August. And 100,000 only a few months ago seemed like it wasn't much, but I think the markets would welcome that, especially after Powell did in his speech mention that the Fed recognizes that the break even for payroll employment now is probably lower because of all the structural changes that have occurred in the marketplace. So we don't have to have job gains of 150 to 200,000 to keep the unemployment rate down around 4%. Maybe it's 100 to 150,000. So we'll see how the number comes out. But if the Fed does in fact reduce interest rates, whether it's justified or not, in my scenario, it's not really warranted. In a scenario where I'm just wrong, that the Fed says we're going to look through inflation, it's just temporary. We're not particularly concerned about some of the service inflation rates, which remain relatively hot at 3 to 4%. So we're looking through inflation. We're giving more weight to the labor market. Either way, if we get a rate cut in September, I think we're looking at a potential melt-up in the market that'll feel kind of like 1999 all over again. And that's what we saw on Friday. It certainly felt like that kind of market. The good news on Friday is the market did broaden out, and I think the market's signaling that if we give the market more rate cuts, the mid caps will do better. The mid caps, a lot of stocks that are story stocks that have no earnings, they did well, and that just shows the extent to which risk on will spread if interest rates are cut. Again, with the market at an all-time high, with Bitcoin doing extremely well, with gold at an all-time high, it kind of raises the question: tell me again why we need a rate cut? Why do we need a Fed put? In the past, we had needed Fed puts because of financial crises, and it's hard to see one right here. Anyways, it's a bull market. And it either goes up led by earnings, which is what we're rooting for, and we're very bullish on earnings. Earnings turn out to be very strong in the first and second quarters, much better than expected. The surprises, I think, were larger than usual to the upside. And the margin held up pretty well at over 13%, which is, we had a record high in earnings, a record high in revenues for actual S&P 500 earnings and revenues, and the margin held up well, which is quite remarkable, because you would think with all these tariff costs going up, maybe some shortage of labor issues, that the margin would get squeezed. The only explanation, in my opinion, would be the productivity is in fact continuing to make a pretty good rebound here, which of course is consistent with our roaring 2020s scenario. So let's have a look at a few charts here, and then at this time maybe I won't be such a hog, and I'll leave a little bit more time for discussion with at least through the Q&A. So here's the chart collection for today. The focus was on the Fed chair's speech. He spoke. He told us what his latest thinking is. So here is the very weak numbers that we had in May and June. We had an uptick to 73,000. Doesn't look like much. Maybe we'll get 100,000 if I'm right. If I'm wrong, then this will be revised down, and it won't be 100,000, and the market will discount maybe 50 basis points on September 17th. So this payroll number, we always say that the next payroll number is the most important payroll number we've ever had in our careers. And I guess we can say that again about this one, and then maybe it'll turn out to be a non-event. But this is clearly an important story. In his presentation, Powell didn't show this chart, but he's previously used this chart, and he did discuss what it's showing, and that is the labor market is in balance. Supply and demand are in balance. It's kind of you can see back here where the supply well exceeded the demand according to this chart. Here we've seen that the demand has exceeded the supply, and now they're in balance. And both have been weakening. So has the demand been weakening because it's just kind of being in line with the supply side of the labor market. Meanwhile, the unemployment rate, at least through July, was 4.2%. Nobody is really talking about the SOM rule anymore. I've previously explained that when you look at these surges in the unemployment rate, which obviously coincide with recessions, by definition, when you get a lot of job losses, you get a recession. And yet we haven't had that kind of spike yet. You go back in time and you see that a lot of these were caused by the Fed tightening. Okay, so the Fed tightened, and that led to a financial crisis. Okay, so in 2023, early in 2023, we had a banking crisis that lasted a weekend, basically. But it didn't turn into a credit crunch, and that's what happened in the past. Fed raised interest rates. Raising interest rates caused a financial crisis. The financial crisis morphed into a economy-wide crisis. Usually they were banking crises. This time the banks are in much better shape. There's more credit done through non-bank sources, so that if they lose money, it's a haircut on a rate of return rather than a haircut on capital, which then affects lending of the banks. So we just haven't had a crisis, so we haven't had a recession. And there's lots of other reasons why the economy is resilient that we've discussed in the past. Meanwhile, job openings per unemployed workers was 1-to-1, just kind of consistent with this chart. There's as many people unemployed as there are jobs. So that's not a bad situation when you can look at the history of this thing. This is still suggests the labor market's in good shape. This shows you the foreign-born civilian labor force. This is the population of foreigners, and this is the labor supply, labor force of foreigners, and so that clearly is having an impact. Civilian labor force, Powell mentioned has gone down. So on the inflation front, it looks as though Powell has adopted the idea that we should look through it, that tariffs are having an impact. They definitely are having an impact on durable goods inflation. We know that. Trump said, I don't know why I keep saying Trump. Powell said that he, that some of this tariff is kind of a one-off thing, but he then also recognized that one-off doesn't necessarily mean that it's 1 month or 2 months. It could last a while, especially now. Now I can mention Trump Trump is talking about slapping tariffs onto furniture. So Trump loves the power of tariffs. So we'll see if there's more to come, and if there are, that could continue to put some upward pressure, at least on durable goods inflation. By the way, let's not forget that sometime between now and the end of September, we may very well see that the appellate court rules that Trump doesn't have the power to do what he's been doing with tariffs, and that could get to be a pretty messy situation. I haven't quite figured out what the markets will do with that. Bond market may actually be disappointed to the extent that the bond market was starting to see that tariffs were bringing in revenues, and now suddenly they're not going to be bringing in revenues. So that's something to be aware of. Stock market may kind of cheer it. Stock market seems to want to go up whether we have tariffs or not. But anyhow, so here we've got the personal consumption expenditures headline versus core, and you can see that the headline is running closer to 3% than 2%. I should say the core is running closer. It's 2.8%. And I guess we can say, well, what's the difference? Come on, it's close enough to 2%. It's got a two handle. Let's lower rates, and maybe that's the attitude the Fed will have. Kind of doubt it if the next group of inflation numbers are hotter than 2.9%. And like I said, it could be 3.0% for both the CPI and the deflator on a core basis. Housing services, he mentioned, are coming down. They're still elevated here at 4%, but they are coming down, and that's something I guess the Fed is willing to look through again or extrapolate that it's going in the right direction. Meanwhile, services, ex energy and housing are still running relatively hot above 3%. But Powell mentioned that that's okay because was consistent with 2% inflation in the past. But I don't really, I guess he's kind of looking at over here. When you look over here, we had 2% inflation in services, ex energy and housing. So again, he seemed to really turn dovish in terms of his interpreting of a lot of the data. Super core inflation rate, the CPI actually went up in July. We'll see what the PCED services less energy do. So the jury's out. I would argue that inflation's closer to 3% than 2%. If the Fed goes ahead and eases there's a credibility issue. The bond yield might, I think we'll have to watch the bond yield. If the bond yield kind of sticks around 4.25% or goes higher, it'll be like deja vu all over again. The bond vigilantes don't believe that the Fed rate cut was warranted, and that's what we saw back late last year when the Fed cut the Fed funds rate by 100 basis points and the bond yields went up 100 basis points. Expected inflation, Powell mentioned, and he's right. I mean, it looks like they're fairly well anchored, so he's happy with that. So where does it put us? We're thinking that if we're right and there's not a rate cut, there could be a disappointment maybe in September from the FOMC. Also, we could have the appellate court rule that Trump doesn't have the authority. So, September, we're always on the watch out for trouble because it tends to be a troublesome month. So I can think of two things that could upset the market. But if that's the case, I think we'll still be looking at a year-end rally that'll get us to 6,600. 6,600 is 300 earnings per share next year. The market anticipating that times the current multiple of 2022. That gets us 6,600. Next year is 7,700, and we do that by saying, well, the market by the end of next year will be looking at 350. 350 times 22 is 7,700. And obviously, we can have a long discussion about is 22 relevant here? Is it sustainable? I think as long as we don't have a recession, as long as there's a perception that of the kind of the roaring 2020s scenario where technology really is making a difference to productivity, I think the valuation multiple could stay that high. I'm not assuming that there's any changes in concentration. The Magnificent Seven could continue to account for 30%, and they have a 30 forward PE. So I'm going to stick with 2022. The downside is on this chart is using an 18 PE, which is not exactly the end of the world, but in terms of valuation multiple, but it certainly would be quite a different scenario for the market. Clearly, a more correction, bearish kind of market. If the Fed actually does go ahead and cut rates, whether it's justified or not, we could be looking at these same numbers happening a lot sooner. Okay, well, I talked too much again, but I left a little bit more time than usual. So let's see what we got here. First of all, thank you all for the nice turnout. I always appreciate that. Cagdus. Hi, Ed. On the back of the latest developments from the Fed, how are you thinking about the bond yield? What's your range, or where should we aim in that range? I'm sticking with the 4.5% plus minus 25 basis points. So we last I looked, we were at 4.25% or thereabouts. Stock market got real excited on Friday. Bond market, I mean, we saw the Dow go to a new record high. We saw the S&P 500 and the Nasdaq rebound closer to their recent record highs. Bond yields are still in that trading range, and I'm kind of sticking with that idea. Michael, you mentioned how things are looking like 1999. Assuming the melt-up scenario plays out, do you see a 2001-like dot-com crash? No, the dot-com crash, those were really companies that had absolutely no earnings. I mean, right now, information technology and communication services account for, I think it's about 42% of the market cap of the S&P 500. In the tech bubble of 1999, I think we got to 40%. So the market cap share, oh, Max is here, the market cap share is now higher than it was back in 1999 when we look at information technology and communication services. On the other hand, the earnings share of those two sectors is about 10 percentage points higher than it was back then. So there are actually earnings that are justifying this melt up. I don't really have a problem with an earnings-led melt up, and earnings have been very strong. The forward earnings numbers have kind of accelerated to the upside, so that's a good thing. I could get the market up to 7,500 by the end of next year just with earnings, without changing the PE, which is what we were just discussing. But we could just have a correction like what we had at the beginning of the year. We could have a bear market. But again, I don't think if we're not gonna have a recession, if the economy is going to remain resilient. Look, if the Fed's willing to lower interest rates to avert a recession, which they clearly are, I just don't see that it's going to be 2021 and 2001 all over again. Okay, Gary, any concern over some aberration with payroll numbers, and then whether to believe them or not, and how would Mr. Market react? Great numbers and investors believe Fed won't cut. That is great number. Oh, if there are great numbers, investors believe. Look, yeah, clearly Trump is onto something when he fired the head of the Bureau of Labor Statistics. Why the head of the Bureau of Labor Statistics hasn't been going to Congress on a daily basis and screaming that we need more money in order to do our job is grounds for firing, I think. But the idea isn't to replace that person with somebody who will jimmy the numbers. And I don't know this new BLS person. There's some controversy about them, but the BLS really does need more resources so they can do a better job with employment, with CPI and numbers like that. So, but right now it looks as though the markets are still willing to kind of take them at face value. So you know what I always say: when the numbers support my data, it's good data. When they don't, they're going to be revised, or there's something really wrong with them. Let's see. But again, as we just learned, it's not just what August payroll number will be. It'll also be what the revisions are to June and July. So we'll see. It'll be suspenseful. But again, we got the Fed put in our pocket, right? If the economy is weak, the Fed will lower rates. Gotta love the Fed. Lee, while dropping the Fed rate when it should not be, has in the past caused a revolt by the bond vigilantes, spiking long-term T-bond rates. Could that be negated if the Treasury switches to short-term notes to fund deficits? Yeah, we've discussed that. We've discussed the possibility that the Fed would respond to, that the Treasury would respond to a pickup in the bond yield by issuing more short-term debt. That's exactly what Janet Yellen did in 2023 when the bond yield went up from, what was it, from 4 to 6%, 4 to 5% in 3 months. And she responded by saying, okay, I'm not going to increase the issuance of bonds, but I will finance more with bills. And it worked like a charm. Bond yield got to 5%, came right back down. I'll take a couple more if you don't mind hanging on. Paul, good morning, Ed. I don't recall reading much about the disparity between international and domestic equities this year. It appears the difference continues to be maintained. What might cause domestic equities to start outperforming? I don't know. I mean, I look at the U.S. MSCI divided by the all-country ex-U.S. MSCI, both in dollars and in local currency for the foreign markets, and the uptrend is still there. I'm not giving up on stay home. I still think I'd rather overweight the U.S., but it's getting harder and harder to overweight the U.S. because it's about 75% of the market cap of global stock markets. So, you know, in my old age, I'm softening up. If you want to find some opportunities overseas and you know what you're doing, that's fine. If you want to do some mid caps, I would focus on the same sectors we've been recommending on a large cap basis, and that's information technology, communication services, industrials, and financials. They worked very well in the large caps. Maybe it's their time for the mid caps to work. Adam, hey, Ed, wondering if you think the breakout in small caps is real this time or another head fake. I don't know that I'd call it a breakout. We've had a lot of breakouts, and at some point you kind of wonder whether they really are breakouts because they haven't worked in the past. I'm actually working on a QT, quick takes on this right now, and I'm just seeing the beginnings of an improvement in forward earnings for the mid caps. That's been what's missing here is the forward earnings of the mid caps have been in a coma since late 2022, and maybe now they're starting to pick up. But then again, it's just a week or two, and I'm looking for reasons why this market might be going up other than mid caps are cheaper than large caps. Why don't we leave it at that? Have a good week. Never a dull moment in our business. So you know, if you're doing this from the beach, I'm sure you're not resting much and probably looking at your cell phone and seeing what the markets are doing. But maybe this week they'll give us a break and the market will kind of mark time after the big move to the upside on Friday. Anyways, see you next week. All the best.